Hi, everyone. For what it's worth, with myself, Ben Hager, and Jeff Hedley. Happy New Year, everyone. Jeff, Happy New Year to you.
Yeah.
Figured I'd kick it over to you and let us know what you think.
Yeah. Happy New Year, everyone. Hopefully, everyone had a great holiday season and a wonderful New Year's. And boy, we're kicking this year off with a bang,
Yeah,
literally.
yeah,
I think, looking at the past year, we want to really kind of hit a little bit on the economy, what we saw last year. You're going to dive in a little bit into the equity markets for what we saw last year, kind of some thoughts this year. I'll take a little bit of time spend talking about the bond market, and then we'll wrap it up with some macro themes as we roll into 2026. How's that
yeah.
sound?
Perfect.
Great. Okay. Economically wise, last year actually was not a bad year. I mean, when we really look at things, GDP was in the 2% range. Inflation came in at about 2.7 for the year. However, due to the government shutdown, we did have some incomplete data. So the next release on the 13th of January is going to be, very interesting and very closely watched. Employment ended the year in the 4.6% range, which was up from 4.1%. So that's something we are going to be watching. And typically, when you see economic expansions, you're in the 3.5 to 3.7%. So this is going to be a theme that we're going to pay some pretty close attention to as we roll into 2026. US debt grew from 37 trillion to 38 trillion. That's a pretty big number. Continues to be something we're watching. The total deficit for the year dropped by about 50 billion. We're still at about 1.8 trillion. But the biggest increase, though, came in the interest expense on our existing debt, which is now at about 970 billion. Ben, this is literally about 3 times higher than it was just 5 years ago. And it's a problem. I mean, this is going to be some of these continuing issues that we're going to continue to talk about in the coming years. One of the other thing that we saw, which really stood out, was the dollar dropped about 9.7%. That was one of the largest drops since 2017. This helped our international investments quite a bit. We do get a nice tailwind from that weaker dollar. But, overall, if we're just kind of looking at, the economy as a whole, really wasn't too terrible last year. So, that was reflected in what we saw, in the returns in the markets at the end of the year. So what are
Yeah.
the things that we saw in the equity markets? Because boy, we had a lot of volatility from the equity markets last year, from the beginning of the year to the end of the year. So what are your thoughts kind of in wrapping that up for us?
Yeah. So I'm just going to touch on one thing, Jeff, that kind of piggybacks on some of your comments about the economy. And I think this is more of a comment or a continuation into 2026. So you touched on, we had a pretty good year last year. Growth was decent, kind of met expectations, maybe a little behind, but it's still pretty decent as far as growth expectations. But you point out some of the challenges around the debt, interest costs, et cetera. I think here's where, and concerns of maybe inflation, et cetera, I think here's where we start to look at 26, and especially conversations we've exhausted here in these conversations around AI. There's a big push or expectation that we start to see some productivity come through. The line I've heard from several people is, with some of the challenges we have on the macroeconomic type side, they're looking at that and saying, well, maybe where we've missed the mark on some policy measures that could lead to inflation or could lead to a lagging growth type scenario because of either tariffs, employment scenarios, labor, participation, whatever it is. There's this idea that productivity from corporations could bail out some
Mhm.
government policy issues, right? And so one, that productivity would be good for the overall economic growth. But what kind of comes hand in hand with that then is there's an expectation that earnings by corporations can continue to look really good. So if we look back at last year, the one thing that was absolutely the silver lining and shocker big time was how good corporate earnings were. So coming into the year, there was an expectation of kind of mid-single digits, maybe 5 to 6-ish type percent growth of corporate earnings. And so if you normally would look at returns, then you'd say, okay, that supports about a 5 to 6% growth in the market. Plus you have a dividend of maybe 2%. So you should have like a 7-ish% growth. Well, we were up, somewhere around 17 to almost to 18% last year. Well, how that started to come together was earnings actually grew at 13%.
Right. Right.
right? So they like doubled expectations, one. So that was a great surprise. And then we add in a little bit of a dividend. So we're at about 15. So, math here is starting to add up pretty quick. And then you had a little bit of expansion of multiples, but not terrible. So the market, quote unquote, that what that means is it kind of got a little bit more expensive, but not terrible by any means. So coming into this year, the expectation is similar. We think we're going to have pretty solid earnings by corporations again, but if that productivity grows, that can push us even further in that right direction. So
And that
just a little note on that side.
And that productivity is also key and goes back into the AI conversation as well, correct? From a standpoint that AI is supposed to help increase productivity. And this is something that we really need to start seeing to really kind of support that AI. Is that a correct statement?
Yeah. So the idea of the productivity making its way through corporations would start to justify this use at an enterprise level instead of you or I basically using it as a really cool Google machine.
Right. Right.
That's hard. That's hard. That would be really hard math for the billions and billions of dollars that these companies are plowing into their AI capital expenditures to say that this is just Google 2.0. That's not going to generate enough revenue to substantiate all the investments they're putting into it. So this has to be a bigger enterprise type win. There are plenty of examples out there where this is already making an impact, but it just needs to continue to move in that direction and maybe accelerate a bit.
And pretty much everywhere, equity markets were good last year.
Pretty much everywhere, equity markets were good last year. Some of the, let's say, lower sized companies struggled a little bit more. So it's still the large businesses dominated. So that's where the performance came from in general there and overseas, as you touched on, Jeff. Even the emerging economies did really well last year. So, and again, a lot of that is a dollar story more so than earnings for sure. But I think the other thing outside of last year being an exceptional year that I'd like to touch on, so I call this just kind of market math that's really important. And this isn't about, adding up returns and whatnot. This is about putting us as investors, you, me, all the families we work with, is putting us on the right side of odds, right? Always putting the odds in your favor for these long-term returns that ultimately are supporting what is most important to us, right? So last year, exceptional year. What wasn't exceptional or abnormal was the fact that it took patient investing,
No,
right?
yeah.
Patient investing is important. And so what do I mean by that? You could boil it down to basically 4 days last year is all that mattered. And that's what added up to your return of almost 18% last year. Because you could look at those 4 days and then basically every other day that was a market open day just kind of offset each other.
4 days.
4 days in total. Well, obviously the communication that comes through then is we need to stay invested. So let's talk a little bit more details about that, kind of get through some of the math here. 2025's win rate, so meaning up day versus down day, was 58.6. Our total for all of the 2020s so far was 57.3. I would say those two combined, slightly better than average. The message here is that the edge is small, meaning it's kind of a coin flip on any given day as to is the market up or down. The edge is small, but it's important to understand that that edge does exist. And this is why we stay invested, even in a calendar year. But then when you start to stretch that timeline out further, the odds get better and better, right? So if you looked at a year in total, the odds of any 1 year being positive is about 75%. You stretch that out to over a 3 year, a 5 year time frame, it gets into the 90s. You get the point, right? We want to keep the odds in our favor. And part of keeping the odds in our favor is not trying to think that we're going to be smarter than the market and predict where it's going next, right? So going back to this 4 days, I'm going to touch on this real quick. I thought this was shocking. So these are our 4 days. March 14th was up 2.1. April 9th, this was the tariff time, up 9.5. That was the positive reaction as they backed off. April 22nd, up 2.5. And May 12th, up 3.3. What's interesting is if you look at all those days, they are also in very close proximity to the worst days that we had last year, right? So this is where obviously when Jeff and I talk in nauseam about we got to stay invested through the bad days, this is why. The bad days tend to be followed by some of the best days, right? So to try to miss one, it means you're going to miss both, is realistically what's happening. So
What's interesting is how combined those days were. I mean,
Mhm.
literally, we're talking
Really close.
2, 3 months.
Yeah.
That's where all the
And
return came.
that's where all the returns came. And one other interesting stat for everyone is if you look at the 2020 in total and you take out the days that were most meaningful to returns, all the remaining days, they basically average out to a positive 0.06% return. So again, you miss the biggest days and it becomes problematic in the long run, right? So let me just touch on just one last thought here. We talk about the fact that most of them were combined there in that March, April, May timeframe. All of us know that a lot of that had to do with policy shocks.
Yep,
So let me just touch on this real quick. So 2020, we go back to 2020, COVID, and what did it take for us to get through that? It was an extraordinary fiscal and monetary action stabilized markets. Otherwise, who knows where that would have gone.
correct.
2025, when tariffs were announced, capital markets quickly signaled this is not popular. This isn't going to work. This is going to probably be a problem for growth. And so, as growth expectations needed to suddenly change, as those words came out of the administration's mouth, we had to adjust pricing, and it adjusted rapidly. But then, obviously, then as they recognize that and they undo that or kind of temper expectations of that policy, what happens? We got to go the other direction really quick. That presented a lot of policy or a lot of volatility via the policy that's being administered. But it just speaks to this idea that headlines can be volatile, that policy path can pivot quickly, and therefore markets are going to adjust rapidly. And I think it's just the reality is it's just the world we live in. We can like it, we can hate it, we can agree with it or not. I think it's just something we need to understand. And again, come back to this idea of market math and how do we deal with this?
Yep, absolutely. So should we pivot to something boring? Like bonds.
Fixed income is
I love fixed income.
it's your world, man.
I find the fixed income world just fascinating. Well, very much like the equity markets, we had a great bond market clear across the world. The Bloomberg Global Ag was up a little over 8%. The Bloomberg US Ag was up about 7.3%. What were a lot of the things that drove that? Well, part of it was monetary policy. The Fed cut rates 3 times. And this is what becomes very interesting when we look at 2026 is where is the Fed going to go? They've got a dual mandate, and that dual mandate is 2% inflation and full employment.
Yeah.
We are really at odds right now with that problem. Yes, we're seeing the unemployment rate go up a bit. There's no questions about that. But 4.6% unemployment still is a really good number in the United States. So if you're not necessarily worried about the employment market, okay, at that point, you really shouldn't be cutting interest rates. If you haven't hit your inflation target, which they haven't, you ought to be raising interest rates. So now the question becomes for the Fed, do they let inflation run a little hot and really kind of lean into maybe the, unemployment and the labor market softening up? This is going to be a really interesting conversation, especially with Jay Powell stepping down in a little bit, a couple of months here, and new people coming on to the Board of Governors. It's going to be interesting how they handle this thing. So that's gonna help lead to some of the interesting things that'll happen in the bond market in 2026. The other thing is, quite frankly, going back to that debt. When we're sitting at $38 trillion in debt and, our interest costs in particular are almost $1 trillion a year, that's a problem. We're starting to see those interest rate costs on our existing debt get to the point where it's stripping out cost of military, some of the social services. So it's becoming one of the biggest line items that we have in the government budget. So
Yeah.
obviously the administration wants lower interest rates because they want to push down some of those interest expense on the debt that they've got to issue, as well as a lot of this debt that is coming due, which is a wall of debt coming due that we've got a problem with. Rates are a lot higher than when it was issued 5 years ago. So these things are going to play into the bond market in 2026. Clearly, if people are looking at us and saying, hey, you just aren't as credit worthy as what you've been, your fiscal house is a wreck, they're going to demand higher interest rates. And yes, the
Yeah.
Fed can control that short end of the market, but that's about all they can do unless we want to start getting into some very interesting ways of rate controls that the government may pursue. I'm not saying they're going to, but it has happened in the past. If we go back to that, that creates some additional issues also. I think that if we looked at 2026 and I had to put my money on where would we look at the end of the year, I think we very well could see lower short-term rates, higher longer-term rates, a much steeper yield curve. You know, I think that is probably going to be one of the most interesting things as we go through 2026 is the bond market. And
And I
again,
think it's Jeff, and it's important to like just pause on that for one quick second. The idea that short-term rates could be lower because that's what they can control, longer term rates might not. Like, well, let's just assume maybe they stay where they are, if not maybe push up a little bit as some stress comes in on that. I think it's important to acknowledge for all of us, right? For all of us, that are buying cars or investing in mortgages, whatever, that long part,
right.
that's what controls our outcome. And so
Absolutely.
obviously the concern here from a pressure on the economy is are we necessarily going to get lower rates to help consumers with house purchases, funding of vehicles or other debt items, right? Maybe not.
Absolutely. And that's a problem because we go back to the affordability
Mhm.
conversation that's out there. I mean, when we talk about inflation, we very well could see one of the big elements of inflation, which is, housing go down, which could help bring inflation down a little bit. But then you got other aspects of that inflation number, things like food, things like purchases, consumer goods, things like that, they could be going up. And the 10-year treasury really is kind of the benchmark for mortgages. Generally, you've got historically about a 1.6% spread over the 10-year treasury, which is your mortgage rate, 30-year mortgage rate. So again, if we see that 10-year treasury start going up, affordability in the housing situation is not going to drop. Things like
Right.
credit cards. Credit cards. I mean, right now you look at a lot of credit cards and they're low end 22, high end 37, medium somewhere in the 30. And there's a lot of people that don't pay their credit cards off every single month. That puts a strain on the economy. That goes back to that K shaped economy that we have kind of talked about, where, the higher up echelon is doing fine. The middle and the lower is not doing that well. So the economy is going to be very interesting. How it shakes out, the bond market is going to be a very interesting and important part of that, but this is going to be something that I think that we'll definitely see some volatility in 2026. And to throw out, Italy, Japan, the UK, France, United States. I mean, quite frankly, we're all in not great shape right now.
We're not the lone man standing out here with a high balance of debt or, a rough balance
Absolutely
sheet.
not.
We're in good company.
We are, and you and I have kind of joked about it, but it's not really a joke. But some of the emerging markets, quite frankly, have better balance sheets right now than the developed world. That is something that we have not seen before. So things will definitely keep an eye on. So if we think about 2026, some things that really kind of come to the top of my mind is policy uncertainty, which leads to market volatility. We got a lot of geopolitical issues going on. We kicked this year off, obviously, with the Venezuela situation. The market has handled it pretty good right now, but a lot of those different types of geopolitical moves, the policy uncertainty, it leads to market volatility because people don't like uncertainty. So I think that's going to be an issue we got to look at. Federal Reserve independence. If we get a lot of pressure on the Federal Reserve to do things maybe that they don't want necessarily to do or do, that'll put pressure on interest rates. And then I think that, on the bigger, broader thing, what's going to happen with tariffs and AI. Those are two conversations that I don't think are going to go away anytime soon in 2026.
Yeah. It feels like what is exactly the same as, gosh, us working together for 20 years. And I'd say probably every year for all 20 of those years is plenty of things we don't know.
Yeah,
And we're
exactly.
going to find out all in
Absolutely.
good time, right?
Absolutely. That's what makes our job, quite frankly, not boring.
Yeah.
Although sometimes
And
boring is good.
It can be, and it just makes me think about the fact that, again, we wanna avoid the idea of trying to predict or try to make assumptions. It's just being very clear about what's going on today and how can we position ourselves best to deal with it.
Yeah, and I think if anything anyone should take away really that should resonate in their brains from this call, 4 days. If you are not present, you do not win. 4 days. And
Absolutely.
that's shocking. So,
Good, kinda bottom line of the last 20 minutes or so, Jeff. I appreciate it.
exactly. Absolutely. So, wrapping up, the one thing I would like to say is we kind of left a little teaser at the end of our call last month that we had a big announcement. So,
There's a
please,
great incentive to open your email and read that newsletter
yes,
now. I
great.
wanna see record number of openings of that newsletter, and I don't think
Absolutely.
anything could make Morgan more happy than
Right,
seeing
correct.
record number of openings.
So we're gonna leave with that cliffhanger, and we'll be back next month.
Cheers to a great 26.
Absolutely. Bye bye.